everyone, this is Rob Roy and welcome to tonight's Option Axiom webinar. You know the drill. You've attended a lot of webinars in the past. Before we go any further, we need to show you our own obligatory disclosure, so take a couple minutes to have a peruse through that. What do you think of the intro music tonight? Keeping with the bagpipes theme, but giving you a little bit of a break from the rock and roll bagpipes courtesy of AC/DC. Bagpipes were certainly one of the great things, Amazing Grace coming out of Scotland, other than Rob Roy McGregor, of course. But most people don't realize that AC/DC, the group, actually came from Scotland. Most people associate them with Australia because they lived there for so long, but they're actually all Scotsmen. Just trying to give you a little diversification on the bagpipes, that's all. Let us know what kind of genre you like a little bit. So many of you sign in early. You want to make sure that you have some entertainment before we start. Support staff is on tonight, so they'll be able to record your comments. Alright, let's go ahead and move on to tonight's webinar, which is the reality of trading butterflies. Obviously a subject that people are very interested in, because this now, we've been having some large webinars, but this is by far the largest webinar we've had. We upgraded our service that we use for our webinars because we were getting so many people. Now we've outgrown that as well, so we actually had to turn some people away from tonight's webinar, believe it or not. So there'll be some that are listening to this recording that actually weren't able to attend, but that's a great problem to have. Other than we're outgrowing the technology, we continue to expand the technology and our audience is expanding even faster. Again, a great problem to have. We also have an awful lot of new people the first time with us, so bear with me for a couple minutes while I give you a little bit of my background. As I mentioned when we started, my name is Rob Roy. You know, I'm a descendant of Rob Roy McGregor now from Scotland, if you didn't know that before. Spent nearly 13 years as a golf professional, so when you see the words former golf pro, PGA golf pro, a lot of people say, well, why former? Why would you ever leave that career? Sounds like a great job. It was a job that was an awful lot of fun, but it was extremely time consuming because I was a club professional, and being a club professional in Florida, it's a 7-day-a-week job, especially in the season when everybody's down from the north. In the off season, I was able to take 1 day a week off, but that was Monday. That means working all holidays and all weekends. And as much as I love golf, that doesn't leave time to do anything else. And there are other things in life that I enjoy doing as well. So I realized that I needed to make some sort of a transition so that I could have a little more enjoyment out of life. Have you ever wondered what it would be like to just wake up in the morning and do what you wanted to do that day, rather than do what you felt like you had to do that day? I can't be the only one that ever wondered that, and that was kind of the stuff that was going through my mind. I decided that I needed a career change. The only other thing that ever interested me, honestly, was money and how money worked. So I said, hey, I'll become a financial advisor. That seems to be a good thing to do from the money side of things. I got an insurance license, securities license, mortgage license, went through all the training, did everything you need to do to become a traditional financial advisor, and that's how I moved into the world of finance. The problem was I realized pretty quickly that I didn't like having a boss. So in 1996, I started my own financial services business and was an independent financial advisor, meaning I wasn't a captive agent tied to any one of the major companies that you see advertising on TV all the time. There's a reason that they're all advertising like that. It's because they charge padded fees to pay for all that type of advertising and all the other things that they do, the big huge buildings that they build in every city, etc. Well, it turned out that there's a lot of other people that wanted to be independent as well, and the independent financial advisory firm grew. In fact, it grew so fast and we did so well, I was noticed by publishers and appeared in the who's who of financial advisors. That caused the head of the Florida School of Insurance to contact me and ask me if I wanted to go teach the licensing course. So I did in Orlando, Tampa, and Miami, obviously 3 major cities in Florida. So I got the opportunity to teach those that are getting ready to move into the financial services arena, and I discovered I liked that. I like being able to share my experiences with people that were getting ready to get started and give them some ideas on how they can move forward and be more successful. The problem was the traditional financial services arena. I would imagine many of you have visited with a financial advisor before, and you probably filled out a risk tolerance questionnaire, and your advisor took that, determined where your risk was, and created a wonderful asset allocation plan from your own risk tolerance, and divided your assets according to that allocation. And then the idea is you're supposed to leave it there forever. The long-term buy and hold, which sounds great in theory, and boy, you can make a great presentation of it. It just doesn't really work that way in real life. I discovered that if the market went down, no matter how great the allocation plan was, the client's quarterly statements would come in and they were losing money. And I just thought there's got to be something better than this. And I remembered these things called options when I was going through my securities licensing. So I attended some options seminars and gained some education and knowledge on trading options and became convinced that that's the way to trade in the world. Very low risk, high potential reward, and leverage. I mean, what could be better than that? I was dismayed to find out, however, that the traditional financial services establishment not only doesn't condone financial services advisors trading options for their clients, they don't condone advisors trading options for themselves. And a beautiful lady has a famous expression, "That's crazy." And that's exactly what I thought, borrowing her expression. That's just simply crazy. So I decided I can't feel good about this. Besides wanting to do it for myself, I wanted to share that information I was so excited about. So I literally walked away from my financial services business and handed my entire personal book over to another advisor in the office and became an independent contractor to go out and trade or teach the trading of options, which I believed so much in. And I was fortunate enough to latch on with some of the top options education firms literally around the world and travel the world teaching option education seminars. And it's likely, because the options world is pretty small, that a lot of you listening may have attended an event that I did for some other company along the line. Well, as I was going out and teaching options, some of my old financial services clients came to me and they said, "We don't like this long-term buy and hold stuff either. Can't we just follow along with what you're doing?" And so I actually created a system where I would alert those select few of what I was doing personally. And as I was continuing to go out and do these option seminars, I learned about the 80-20 rule. And for you business owners out there, that doesn't mean the 20% of your clients deliver 80% of your business. I'm not talking about that 80-20 rule. I'm talking about the fact that in the world of going through seminars, only 20% of the people that attend seminars actually go on to achieve any sort of success trading. And some spend thousands and even tens of thousands of dollars without any success. Certainly not the type of a success that they envisioned when they started. And I was hearing the same exact thing going out and doing these options education seminars. People saying, well, there just was somebody that's already been out there doing it that we could follow along with and learn from. And one of the problems of being an independent contractor is you have to stay within the guidelines of whatever company has contracted you to deliver the content. So you can be an individual a little bit, but you still have to stay within their guidelines. And nobody was offering anything like that. And so those were the things, the processes of where Option Axiom was born. I just started thinking, well, if I'm already doing this for a select few people, why not open it up to allow more people to follow along with what I'm doing if that's what they're interested in doing. And again, that's where Option Axiom came from. So that's a little bit of the background of how I got to speak in front of you and how we're together this evening. It doesn't matter what area of the financial arena you're in, whether you're a mutual fund manager, if you're an investment advisor, if you're an institutional trader, your performance is always measured against some benchmark, and the primary benchmark that your performance is measured against is the S&P 500. That's the one most use. They want to be able to outperform the S&P 500. Well, if you look at the chart here, down at the very bottom, the royal blue area shows the performance of the S&P 500, assuming you started with a $10,000 portfolio all the way back into January of 2012. So as you see, the total on the right is through April. So this is a 16-month history of if you had your $10,000 in the S&P 500, what it would have grown to. And all you hear on the financial networks is how great the S&P is doing. Well, the light blue area there, that's the performance of are Option Axiom alerts that have been sent out over that same 16-month time frame. And I think you would agree, from anybody's measuring stick, that's some pretty good performance, and certainly well outperforming that primary benchmark of the S&P 500. So we're very proud of what we've been able to achieve here, and our subscribers are extremely happy as well. I do a weekly update each and every week, and we talk about clear, concise market analysis. The unfortunate part of listening to the financial networks is the fact that all those people on those networks are financial news reporters. They're not traders. In fact, they're not even allowed to own stock. Even Cramer is not allowed to own stock. He talks about that charitable remainder trust that he has, but he can't own individual stocks. And these people are out there talking about all this stuff. In a lot of cases, they're just regurgitating things that are given to them. I've talked to plenty of floor traders that make a joke out of the fact that they can create some outlandish things and say them to these people to see if it actually makes it on the air. It becomes a game with them. So what we do each and every week is provide clear, concise market analysis, our slogan. So I'm going to tell you really what happens. Now, those of you that may have seen me before know that I'm a pretty opinionated person. We'll get into some few conspiracy theories from here and there. So yeah, you're going to get some of that with me. But I'm also going to tell you the real story of what's going on behind the scenes. So if you'd like to subscribe to that, it's free. You can go to our website. Make sure you go up to the top where it's green there and say register for Rob's Market Update. That gives you that free weekly update each and every week. So let's get into tonight's subject matter, the reality of trading butterflies. We're going to talk about some ways to trade butterflies, but before we do that, let's just do a review of exactly what a butterfly is. So if you were looking at an options chain, and let's just say we have 3 strike prices here. Some of you actually may have seen me deliver this part of the presentation at some other event that I've done education-wise on butterflies, but don't worry, we're going to go a lot deeper than anything that you may have seen before. But we have 3 strikes, 95, 100, 105, and the corresponding bid and ask price of those 3 strikes of call option. And so if you were looking at that options chain, how many 5-point call spreads could you create out of those 3 strikes? And the answer is 2. The 95-100 and the 100-105. Obviously, a 95-105 is a 10-point wide spread. And remember, the question was how many 5-point call spreads could you create from this options chain? So out of those 2 spreads, the 95-100 and the 100-105, what if we were to buy the 95-100 spread? That would be buying the 95 call and selling the 100 call. Buying a vertical spread. Call vertical debit spread. Some call this a bull call spread. Some call it a long call spread. But a lot of the conversation on the floor would be a call vertical debit spread. That's what the floor traders kind of refer this as. So buying a 95-100 spread. Why do we create spreads in the first place? Hopefully this is really basic review for most of you. You could simply go buy a 95 call, couldn't you? It's listed in the options chain. It's available. It has a bid in the ask, so you could go buy it. So if you were bullish on a particular stock, you could go buy the 95 call and spend $4.80. You have $4.80 at risk, right? Anytime you buy an option, whatever the cost was or the debit in the position is also the risk. So by bringing in some premium, selling that 100 strike, which brings in 320, we're not going to worry about splitting any spreads in this, we'll just deal with the bid and the ask. So if you bought the 95 at an ask price of 480 and you sold the 100 at a bid price of 320, spending $4.80, bringing $3.20 in would leave you with a net of $1.60. So you're still bullish. A call vertical debit spread is still a bullish position, but you've greatly reduced your debit, and then there also greatly reduced your risk. Remember, the cost for the debit is also the risk. When we go through this, one of the things that I found interesting in just the basic world of spreads was looking at the combination of creating a debit spread. Buying the 95 call, selling the 100 call. Buying the 95 has a fixed amount of risk. Spend $4.80, you have $4.80 at risk. If you were to sell a call option, just sell a naked call, sell the call on its own, sell to open the call, what kind of risk does that have? Unlimited, right? Selling a naked call has unlimited risk. Isn't it interesting that when you combine buying a straight call that has a fixed amount of risk with the selling of a call that has unlimited risk, putting those two together lowers your risk? To me, I always thought, well, if I could go buy that 95 call with a fixed amount of risk and I'm going to combine that with something that has an unlimited risk, seems like that would actually increase the risk of buying the straight call. But it doesn't, it decreases it. I always found that interesting. So you lower your risk down to $1.60. What if we continue on? Instead of buying that 100-105 spread, what if we sell that one? So in buying a call spread, you buy the lower strike and sell the higher, as we just did with buying the 95 and selling the 100. In selling a call spread, you reverse that. You would buy the 105 call and sell the 100 call. So buy the higher strike, sell the lower strike. Now look what happens. In buying that higher strike 105 call, you're only spending $2.45. In selling the 100 strike, you're bringing in that same $3.20 that you brought in when you sold that 100 strike against the 95. So in this case, we are actually bringing in, on the strike we're selling, more money than we're spending on the strike we're buying. So what's that called? A call vertical credit spread. And this is where the world of options education becomes so frustrating, because there's so much misinformation out there. There's so much stuff that's tied simply to marketing. And you can really make credit spreads sound fantastic in marketing them. You place the trade normally out of the money, very high percentage of accuracy, because the fact that it's out of the money, the position or your underlying stock could move your direction, could move sideways or move slightly against you since you have the position out of the money, and you could still keep that credit. And then they market it with, let the market pay you to trade. Why do you want to spend money trading? Let the market pay you. And people get the misconception that putting a credit spread on brings money in immediately. It doesn't, because a credit spread requires margin. So when you initially place a credit spread, you don't receive the credit right off the bat. You actually pay the margin. That money's frozen in your account. You don't realize the credit on the position until the very end. The correct way of calculating margin is the difference in the strikes minus the potential credit. That's what the margin should be. But some of the brokers out there, I'm sure you're aware of this, aren't following that, and they're charging margin for the entire width of the spread. The idea of margin is to protect the brokers against traders that are doing risky things and doing things they don't understand. So margin was created to protect the broker. But why do the brokers need more protection than they are exposed? There's not the entire width of the spread at risk. It's the width of the spread minus the potential credit. That's the risk, so that's what the margin should be, not the entire width of the spread. But there's been so much consolidation out there in the trading world. Options are the only part of the market that's growing. Every other part of trading is actually shrinking, so everybody wants a piece of it. So these other firms that didn't have a big footprint in the world of options have been buying up options brokers. But they haven't been using the options platform. They've been bringing these option brokers in and moving them to their own antiquated platforms, which are not designed for trading options and not programmed properly for it. So it becomes extremely frustrating. But you see people that become enamored and they buy into all this marketing and they see these exorbitantly high percentages of accuracy. But let's go through how this works. Forget the one that's on the chart right now on your screen. let's kind of go with what's traditionally marketed with a credit spread, and that would be a 5-point wide spread looking to keep a $1 credit. That's kind of the traditional way that a lot of people that market credit spreads, that's their format. They try to place it out of the money, but they still want to try to keep $1 in credit. So how much would be at risk out of a 5-point spread if you were looking to keep $1 credit? Be $4, right? I just gave you the formula, the width of the strikes minus the potential credit. Well, think about that. Let's assume you put on 10 credit spreads in a row, and you were right on 8 of them. 8 times the spread expired worthless, you kept that $1, time decay friendly, all that stuff that they market them with, and you bought in, you kept the $1. 2 times you were wrong. The trade went against you. That's an 80% accuracy rate. I think anybody would take that. But what did you net? You kept the $1 8 times. So you brought in $8. If you were wrong and the spread went against you twice, you lost $4 each time you were wrong. On the 2 trades you were wrong, you lost $8. So you made $8 on the 8 trades you were right. You lost $8 on the 2 trades you were wrong. And you netted nothing. But you had an 80% accuracy rate. And you lost the commissions. So when you see the newsletter flyers come in and the advertisements talking about very high percentages of accuracy, well, they better be if they're following that traditional marketing plan, which they may not all, but most of them do. They got to be right more than 80% of the time for anybody to make any money. It's crazy. So I'm not trying to talk anybody out of doing credit spreads, but I've always wanted people just to understand the risk involved of what they were doing before they enter the position. If you understand the positives and the negatives, you understand the strategy, you know it inside out, specifically understanding the risk, and you still want to do it, that's fantastic. Every strategy has its place. So maybe you still like credit spreads, maybe you don't. But what if we took that credit spread, in this case, spending $245 and bringing in $320 would net us a potential credit of 75 cents. So on its own, that 105-100 call vertical credit spread would be risking $4.25 to make 75 cents. Again, maybe that would be okay with you, or maybe that wouldn't make sense to you. But if we combined that credit spread with the debit spread, brought that additional 75 cents in against the $1.60 that we had at risk in our debit spread, what have we netted this down to? 85 cents as a debit, an 85-cent debit. We are still bullish. We could have started by buying the 95 straight call for $4.80, but now we've brought our debit and risk all the way down to 85 cents. We've shaved off almost $4 of exposure here. Putting those two together is known as the butterfly. An outstanding strategy. Interesting to hear me say that, because when I was first going through my educational process in the world of trading options, I didn't want anything to do with them. But you also have to understand that was 20 years ago. Commissions were completely different back then. You were paying $75 to $100 per leg. There was no discounts for multi-leg spreads, none of that stuff that you have now. So if you were going to put on a position that was 3 or 4 legs wide, you were paying $75 to $100 for each leg. So how do you profit in that environment? You have to put on huge trades, right? So what's the offset of putting on a huge trade? A huge amount of risk. So you could make a lot of money or you could get wiped out. It certainly wasn't a good, prudent way to trade, trying to offset all those commissions. So I had no interest in them. And the other thing that I didn't have an interest in was the fact that back then I only knew a butterfly, or had only heard of a butterfly being a sideways strategy, a non-directional channeling sideways strategy. I didn't really like a butterfly to go sideways. I like doing a time spread or a counter spread as only 2 legs wide. I like this strategy better than a sideways butterfly, and it was less commissioned. So I just didn't have any interest in these. On top of the fact that if you look at this risk graph, which it's a really cool looking risk graph, and I guess to somebody with those worthless wings on the top, that looks like a butterfly, or so. I have no idea where the term butterfly came from, but I guess somewhere you can see that that may have resembled a butterfly, but those top wings are worthless, so you take that off and you get the more traditional looking butterfly risk graph. The way the risk graph works is the amount that's underneath the zero line where those wings are, that's your risk, and the triangular area above the zero line is your potential reward. The maximum profit, as you can see, is realized at the strike in common. And there are two ways that you can think of a butterfly: as a combination of a debit spread and a credit spread, or of buying the wings and selling the middle twice, which is the way I like to refer to it. Buy the wings, sell the middle twice, and there's going to be a specific reason why I like doing that, which I'll show you as we get to some examples of this here in a second. Regardless of how you think about it, you would be buying a 95 call, selling a 100 call, buying a 105 call, and selling another 100. So you're buying the wings, you're buying the 95 call, you're buying the 105 call, and you're selling the middle twice because you're selling that 100 strike twice. You sold the 100 strike with the call vertical debit spread, and you sold the 100 strike with the call vertical credit spread. So buy the wings, sell the middle twice. So again, look at the risk graph. The maximum profit is realized if the stock finishes at the strike in common at expiration. And I remember thinking, nobody can do that. Nobody knows where that stock's going to be at expiration. You're really good if you can figure out where the stock's going to go and hit the target price in the first place, regardless of the time frame. But to try to say you know where it's going to be at expiration, nobody's that good. I thought this was ridiculous to think that anybody could think that they were that good. So now I had another reason why I didn't want to learn butterflies. The truth of the matter was they seemed complicated. I had all these excuses on why I didn't want to, but the bottom line was, honestly, they seemed complicated, and I just want to take the time to go through it. Long 95, 100, 105 butterflies is what this would be known as. And if you wanted to trade the traditional sideways, non-directional butterfly, it didn't matter whether you used calls or puts. A call butterfly and a put butterfly, they're the exact same risk graph. Makes no difference whatsoever. There's your traditional way. A sideways at the money butterfly, you've got a stock that's in a trading range, so you buy the strikes where the support and resistance levels are, and you sell two strikes somewhere in the middle. You hope that stock is going to continue to stay in that trading range. If so, then the butterfly could work well for you. When I discovered that you could actually make butterflies directional, and I learned this from an outstanding options trader named George Fontenelles, if you've heard that name before, unfortunately passed away over the summer, which is a great loss to the options world. He's the one that helped me realize that you could take this and make it a directional strategy. I had just never taken the time to go through and understand it that way. And it opened my eyes to a whole new world of trading options. So when we go through this, we have our proprietary strategies at Option Axiom. There's a strategy that I'm really proud of. In fact, I've got some great news to tell you about. Don't let me forget to tell you news regarding the proprietary strategy. But I also like to give credit where credit's due as well, because I learned this from others too. Good part of this, and I want to be able to share that. A directional out-of-the-money butterfly. Well, how are we going to figure out where a stock's going to go? So here's where we start talking about strategies of trading butterflies and patterns that you can utilize to trade the butterfly. The zigzag is perfect for those of you that are in our web series with Option Axiom. We're right in the middle of doing this. And we're going to go a lot deeper into this through the web series than we are here in this webinar tonight. But you get the idea, just a general directional zigzag pattern. That's what this is. It's a zigzag. And you have a price target, which you can figure out approximately where that's going to be by the rules of the zigzag. If you find an impulse move or a directional move, which is the A wave, and then it corrects, and it corrects up to the Fibonacci level, 61.8%, well then you have a high percentage chance of that C wave extending 100%. A very high percentage chance of that occurring. What a perfect opportunity to put a butterfly, an out-of-the-money butterfly, around where the area is of the expected move on the C wave, the 100% extension. It is uncanny how often those levels are hit, but if you put the butterfly on, you don't have to hit it directly, because if you remember the risk graph, look how wide that risk graph is. I was so focused on the fact that you had to try to pick exactly where the stock was going to be at expiration, kind of the couldn't see the forest for the trees type of thing, to not notice, look how wide that triangle, you could drive a Mack truck through that thing. Look how huge that profit area is. Now, it's not the maximum profit, but you're making something. How many of you put on a trade where you're looking to make the maximum profit on the trade? We don't do that, do we? We look to make a reasonable return on a position. So you don't have to get the exact price, just somewhere in the neighborhood. And if you've got a strategy or a particular technical pattern that works a high percentage of the time, and now you've got a strategy where you don't have to be exact, you just have to get somewhere in the neighborhood, I think you can start to see how these two could tie together. Now here's an example. I've actually used this in seminars before, but I've got another one that I'm going to share with you that was very recent with Option Axiom, which I think is a great example as well. But this is a good comparison because it shows placing an out-of-the-money butterfly against a traditional debit spread. So here we have a pattern, a classic pure zigzag pattern from AEM, and you can see where the C wave extension is expected to go down to 60. If you were to put on a traditional put debit spread, buying the 65 put, selling the 60 put, that would cost you $123 for one contract. Keeping a 5-point debit spread below 125 is ideal. I'll spend up to $1.50, but keeping it to $1.25 is awesome. So $1.23 is about as perfect of a setup for a 5-point put debit spread as you could get. But in constructing the butterfly, look how we did it. Buy the wings, sell the middle twice. It's easy to construct these. Where's your price target? The price target on the zigzag was 60. Great. Where's your price target? Sell that strike twice. Well, we're not going to go sell naked options. We're not about doing that. We need to protect those, so we're going to buy a put on either side. We're going to buy the wings. So we sell the 60 put twice. That was our target. We buy a 65 put, and we buy a 55 put. So we sold the strike that was our target price. Then we created the wings. We created our protection, and now we have the width between 55 and 65 in that area to generate a gain if the stock will just come down somewhere in that area. And look what you did to the risk. You knocked it down to $63. You almost cut the risk in half of that put debit spread. See, it was $1.23. This is only $63. Almost exactly half price. Pretty amazing. Well, AEM did exactly what it was supposed to do. That's what happens a high percentage of the time. These zigzags are amazing. So it went down and it hit its target. And notice it did it in the right time frame too, within May. Wow, that debit spread should be huge, right? Well, it did work out well. That $1.23 put debit spread made a profit of $203. That's a 165% return. Well, surely the butterfly couldn't beat that. 165%? A lot of you have been taught to exit a trade when you make 100%. So if you had to exit it already and you let the stock go down and hit its target, which is another thing that learning the zigzags allows you to do, is to have confidence that your target price is going to be hit. But look what the butterfly did. It returned a profit of $205. Now that's almost the exact profit number that the put debit spread achieved. But you had to pay $1.23 to make that $203 in the debit spread. You only had to pay $63 to generate the $205 profit in the butterfly. A 325% return. You still got 7 days left, which is when a ton of the profit is realized in a butterfly. But it shows you that you don't have to hit the target price at expiration to generate a nice return on a butterfly. Just get it in the middle of that butterfly somewhere and you're in great shape. 325% on butterflies. See how well butterflies tag into trading those zigzags? Well, here's our performance over the last, notice what we have here. I was going to add in here that on CNBC a few weeks ago, they reported that the average fund manager for the first quarter of 2013 is up 3%. 3%, that's it, the average fund manager. Look at our returns from January, February, and March. A little better than 3%, but go back even further. November, December, January, February, March, April, that's 7 months that are on your screen there. Pretty impressive, I think you would agree. And look at May already. We're only 15 days into May. We're already up 13% for the month. And you can see at the bottom there, we actually had a losing trade that we just closed out, which I'm going to come back and refer to here in a minute. But look in March. Do you see that huge spike up? That big profit that was generated by Google? You want to take a shot at what strategy that was? You got it. A butterfly. The ultimate in low risk, high potential return type of strategies. Gotta love butterflies. Pretty impressive performance over the last 7 months. I think you would agree, especially against any benchmark. Now, we love to hear from our subscribers. Normally, you don't hear from people unless something's going wrong. But our subscribers, almost daily, are sending us glowing commentary like this. Wow, could you please tell Rob that was amazing? I would have been out of that trade 100 times. You just showed how important it is to stay patient and trust the technical indicators. Thank you for such a great lesson and a nice profit at the same time. That was regarding Apple. So if you look in April, you can see that trade profit on Apple. That's what that testimony was from. Here's another one of one of our subscribers that did even better. Just want to send a quick note of thanks after spending the last 4 months reading and trading along with you. Look at this. I'm happy to say that I have a 57% return on my trading account through April 18th. A little better than 3% that the S&P generated. I think you would agree. Down to the bottom there, he made just under $4,000 on that one trade. That's how we're generating this type of a return for our subscribers. And it's been noticed. Again, I'm going to tease you with the news that I have before we finish up today. So let's look at that Sears Holdings. Now, we told you that. Now, that one was closed at a loss. Okay? We haven't had a lot of them, but nobody's perfect. Nobody's right every single time, nor are we. But we do go through the adjustment process. And that is another way of trading butterflies that I would like you to consider. Remember, the topic is the reality of trading butterflies. Now, what I want you to do is look at this chart on Sears Holdings. See that big move that started in November of 2012? That huge drop down to the end of December 2012? And then it bounced up. And look where that bounce went into February. Now, that was a downside zigzag pattern that was set up. And following along with that qualifying zigzag, we put on a put debit spread. That was the original case study that was sent out. But then that became disqualified as the stock broke back to the upside and broke out of that zigzag pattern. So what we then did was we created an adjustment by putting on an upward moving call butterfly to take advantage of this expected upward move. So notice what happened. On that bounce, instead of that move from A to B being a continued C wave down, which is what it appeared at first, and this is what the people in our web series, by the way, that first web series sold out. We actually had to turn people away from that as well. So if you're interested in any of the future web series, we'll do a few of them a year. You need to make sure you sign up quick. It's always a shame to turn people away, but we're doing homework and things like that, and we just have to limit the space. But this is the type of thing we're going through. So we came down and we had a 50% retracement there from A to B. So that wasn't the C wave extension. That was actually the B wave of an upward zigzag. And one of the things they're learning is that when a pattern fails, what's supposed to happen occurs an even higher percentage of the time. So we made an adjustment into a call butterfly, and with a 50% correction where the B wave was, where it says qualifying zigzag, that gives you a 100% expected move. So the 100% would be around 54 and change. So round that up, expected target would be 55. But you always want to look at the big picture. Even Elliott himself always said follow the higher degree, which was just his fancy terminology. You have to translate his stuff sometimes. Fancy terminology for pay attention to the bigger picture. Look at that gap there that hasn't been filled. The expectation for this stock to go up and stop at that 100% extension, to bounce that far and not go fill that gap, just didn't seem feasible. And where's the gap? It's right around 57.5. So in the case study butterfly that we sent out a 55, 57.5, 60 call butterfly. The target was right around 57.5. That was the closest strike. So we sold that twice. And then we bought a 55, we bought a 60 as protection, so we had that window there. So we were expecting that 100% target to be broken because of the fact that, again, unrealistic to think that that stock's going to go up and hit that area and not continue higher. Now, I've showed you the type of returns that we've been creating at Option Axiom. How do you think we did that? If you had to give me just one word on how you think we've been able to achieve those results, what word would you give me? I would imagine you would say knowledge, right? It's not. It's experience. This is what I'm talking about as far as experience. Learning and understanding a zigzag would have given you a target at 55. Experience tells you the odds of it stopping there and not continuing is remote. That's the difference. That's what helps you get to the upper echelon. Experience. And here's another thing that I like to share with you. You know the expression, we learn from our mistakes? And some people say we learn more from our mistakes. Well, an expression that I like is smart people learn from other people's mistakes. So not only would we learn from our own, but we learn from other people's. And for those of you that are parents out there like myself, what's the one thing you want for your kids? For them not to repeat the same mistakes you make, right? Well, I consider that for my subscribers as well. I've been doing this for a long time. I've got a lot of experience. I've made a lot of mistakes. It'd be far cheaper for you to come along with me and learn from my experience than to go out there and let the market teach you. I promise you that. So that's why we set that up, and we just exited this yesterday. And look what it did. Exactly what we thought it was going to do. So the way we trade this butterfly is we use it as an adjustment. We had two different put-debit spreads that were complete losers. But with the adjustment of the call butterfly, it took what would have been a large loss for an average trader that was just going to simply take their loss and walk away. And we recovered a lot of that and only ended up with a 27% loss by making the adjustment. So we're not right 100% of the time, but you don't have to be. You've seen the results. And look what happened today with Sears Holdings. But to try to get greedy, because we're in expiration week, and you know what happens to the profit on a butterfly as you approach expiration day. It moves up exponentially. But when you're right in the middle of the butterfly, and you're in expiration week, and you don't take that, you're just plain being greedy. What is Kramer's expression? Bulls make money, bears make money, pigs get slaughtered. Don't be greedy. Butterflies are the ultimate low-risk, high-potential return strategy. Even retards can learn this. High-return strategy. Works out fantastically well. Here's a broken-wing butterfly, which we'll discover these and go into them at another time. But it just shows you that every strategy has another step. We can continue to go a step further. Just look at the grid, and this is done on scale so that you can see it. You have the traditional triangular area on the left, and if you count the number of boxes from that red intersection there, the crosshairs in the middle, and go left or right, 1, 2, 3 boxes to the left, 1, 2, 3 boxes to the right, look at the broken wing butterfly. From where those lines cross the zero line, it's 1, 2, 3, 4, almost 5. What does that mean? It means that the width of the butterfly is wider on a broken wing butterfly. So you have an even wider area of profit. And then look over at the left, down there towards the bottom, you have more risk on one side. Less on one side, more risk on the other. So lots of things to consider. It's a good adjustment. It's a good strategy in certain cases, but not in all. This is another one of those strategies like a credit spread. When people learn about broken wing butterflies, they're like, that's all I want to do. It doesn't work in all situations. In certain situations, they're fantastic. In other situations, a traditional butterfly is better. But again, just wetting your whistle there. We'll cover those in detail another time. So go peruse our website. As I said, support is on. Right now, they can help you walk through the website. Go to the home page. If you want to learn more about how our alert service works, you can go through here to the performance page. On the left, we have our graph there detailing the performance. And in the middle, we have a per alert performance. And it gives you a little bit more of an idea of how our model portfolio works. Our model portfolio is based on a $10,000 portfolio. We send out our alerts through email or text. Not everybody can check their email throughout the day, but most people keep their phones with them these days, and so you can have your text message alerts right there with you on your phone. If you have a downloaded app, you can make the trade right there on your phone. Pretty convenient. But all of our case studies are sent out based on that $10,000 model portfolio, which I think that's important to emphasize, because if you look over, those returns are based off of every case study being generated from a $10,000 model portfolio. Imagine if we were using compounding and we were sending out our alerts based on X amount of percentage of the account as it grows. But we don't do that. It's sent out on 10,000 each and every time. So if we were using compounding, imagine what those returns would be. But that wouldn't be fair to newer subscribers that are coming along with us each and every day. So we always base it off a $10,000 model portfolio. The alerts that are sent out are based on actual fill prices. This isn't hypothetical stuff, back testing. These are actual case studies. This is what I'm identifying. I'm sharing with you what I'm identifying and what I'm doing for myself. So follow along based on what we're doing with our model portfolio. And then if you want to see more detail about the actual alerts themselves, you can click on the alert log, learn more about the strategies. We try to get the alerts out in as timely a fashion as we can. We don't put a ton of information in there because we just want to get the gist of what's going on with the alert. We send you out an alert for the entry, any adjustments that are made, which are key. The adjustments is where it's at, and then the exits. So if we go through and put all the information in the alert, it takes too long, you get caught up reading it. We want you to go ahead and be able to follow along with what we're doing in the alert. If you're doing that in a virtual account or whatever you're doing in your own portfolios, we'll get the information out, and then here's the resource where you can go and read more information about it. So we contacted a marketing firm when we started, and we said, for our alert service, based on what we're doing, what would be something fair to charge? And they came back and they said, the market price of what you're doing is $179 a month. That's what you should charge. Well, we started lower. We've already had 2 price increases. Our founding members can attest to this that may be on here. So we've had 2 price increases. We're now at $169 a month. So at our 3rd price, we are still below where we were told we should start. So a lot of people are believing that we are charging less than what we should be charging. And further discount, if you'd like, you can sign up for a quarterly subscription, which the overwhelming majority of our subscribers do, and save an additional $50. Now, I mentioned we've already had 2 price increases. Once you become a subscriber, and I think this is why a lot of people do the quarterly, you're grandfathered in. As our prices go up, and I'm going to tell you about where they're getting ready to go here in a few minutes, you're locked in, you're grandfathered in. As long as you keep your subscription active, you will never have to deal with a price increase. You're grandfathered in at that current price. And one other thing to consider on our subscriptions, and I want to know who else is doing this. If our model portfolio returns a loss, now that's on closed case studies. This is not the month the case study is opened. It's the month the case study is closed. If our model portfolio generates a loss for that month, we give you an additional month for free. Who's doing that? I think that's really putting your money where your mouth is, putting your performance where your mouth is, so to speak. I think that's pretty impressive, and a lot of people have also agreed with us because we've got an awful lot of subscribers. Here's a couple more testimonials you might want to consider. My second month as a subscriber, look at these dates. These aren't cherry-picked, these are recent. Second month as a subscriber, I've already paid for a year of the subscription with my profits. I'm learning so much from the webinars and daily updates. I'm recommending Option Axiom to my friends and family who want to learn more about trading. This is definitely the place to learn and earn. And I appreciate the reference to the bagpipes too, kind of our little signature thing. This just came in today. Thank you. Very pleased to be part of this program. I think I'm finally getting a good grasp on Rob's approach, and I'm looking at the first solid positive return since I started trading options. 10% in 6 weeks. Wow. Well, we're not going to rest, I promise you. We're going to try to continue to do, and I can promise you that there is nobody that is more passionate about this than I am. I mean, I'm going to be right all the time, but we're going to try to do our best for you each and every month. Now, if the alert service was the only thing we did, we only did the alert service, we were told $179 is what we should charge. But look what else you get. But wait, there's more. Not only do you get the alerts, I'm going to give you a daily update every single day, give you that clear, concise market analysis. We'll tell you what happened each day of trading and do a rundown of every one of our case studies every single day. In addition to that weekly update and a weekly outlook where we tell our subscribers what to expect for the coming week. So we'll review the past week in the update and we'll take a look at the coming week in the outlook. And then we have these web series webinars that come along with it. And there's massive discounts for all of our subscribers for anything that we do. And these webinars that are free along the line. Now, what I wanted to tell you, I've been saying this for a couple weeks, that we have been noticed, and one of the top financial publishing companies in the country has contacted me. They want to publish that proprietary strategy. They're so impressed with it. They want to publish it. The guy said he's really busy, but he's going to push that to the forefront. He wants to market Option Axiom, but he's agreeing with what others have said, is we're not charging anywhere near enough. I don't have the exact amount of where the prices are going to be going, but I can tell you this. I can give you the neighborhood. It's going to be about twice what we're charging now. That's going to be part of their deal in order to publish us and be the marketer, because that's what they think it's worth. And so you're way underselling yourselves. So if you have been following along and you are interested in coming along with us and you haven't done so yet, now is the time. This is the sense of urgency that you need to consider, because I'm just relaying what the talks have been. The price has not been finalized, but that's what the numbers are that they're talking, that the price is going to be somewhere in the neighborhood of twice what it is now. So take advantage of this opportunity if you want to come along with us. Thank you so much for your attention this evening. Hope everybody has a terrific week. Look forward to talking to you again soon. For our subscribers, look for the update a little bit later on tonight, and then we will be back with you again for an update tomorrow. Support is on. If you have any questions regarding the subscription, navigating the website, whatever, take advantage of having them as a resource to do a fantastic job. Take care, everybody.